which typically lets us know how does the fund perform when the benchmark is in a bull or in a bear run. The next that we would be covering would be the risk versus return scatter plot, wherein on the x-axis there would be the risk, which is standard deviation, and on the y-axis there would be annualized return. And we would be having a scatter plot wherein all the funds that are there in your list would be getting placed based on its risk and returns as a parameter. Followed by that, we would be looking upon the drawdown and recovery analysis, which tells us after falling down, meaning after the NAV falling down, how quickly does the NAV of any of the fund that you're currently looking upon recovers. Lastly, the topic that we would be discussing would be the rolling returns analysis, which would let us know the consistency of the funds that we are loading in. In the end, the quorum would be open for a Q&A session. You can either unmute yourself or type down your questions in the chat box. So let us begin. So this is our NGEN Markets landing page, being the Markets tab. So the topic for today, the first topic being value at risk, I'll just load a single fund and explain the topic in detail. So I have loaded this fund in a new tab, Mirai Asset Midcap. I'll quickly change the start date for this specific fund. Let's say I just want to analyze this for the last 5 years. So the start date has been picked up as 6th August 2019. Then I'll go to the fund performance and I'll scroll down wherein we can locate VAR, which is basically an abbreviation for value at risk. So this basically tells us what is the value of our fund that is at a risk. At a risk of what? At a risk of losing. Now, what does this say is right here, there has been mentioned as 95, meaning it says that with a 95% confidence interval, there is a 5% probability. Now, how did I arrive at 5? It is typically subtracting 95 from 100. So that is how you come up with that 5%. It says that with a 95% confidence interval, there is a 5% probability that if history were to repeat itself, the capital erosion, meaning the value that is at risk for this fund, would be 26%. And similarly, in the given time duration, the value at risk would be 29% for the benchmark. Now, if we put this into simple terms, let's say 100 rupees is invested in both the fund as well as in the benchmark. The capital erosion for the fund would be 26 rupees, while the capital erosion for the benchmark would be 29 rupees. So typically, value at risk lets you know the downside risk of each of the fund. And since this is available on a portfolio level as well, it also highlights the downside risk of a portfolio too. Now here you can see two types of value at risk has been mentioned: historical as well as implied. Now the methodology of calculation of both these VAR remains exactly the same. The only difference is the underlying factor that is considered while calculating the both. Historical value at risk is calculated on the basis of historical returns, while implied value at risk is calculated on the basis of historical volatility. Now, we also have provided question marks against each of these ratios. You can anytime hover on these question marks, which typically gives you the explanation what these ratios are and how are they being calculated on the platform. Now, here you see confidence interval 95 is something that gets by default, but these confidence intervals that you see can be edited anytime. And it is typically an industry standard to keep these confidence interval at either 90, 95, or 99. Now, since we have understood the meaning of value at risk, let's rather go and create a list of funds which we want to analyze based on its risk parameters. So for that, I go to this Funds tab. In the Funds tab, you will be able to see two tabs which could help you to screen or rather filter funds based on your specific filter parameters. First being the Screener tab. So this section in the Funds tab has typically 6 filter parameters that could help you to filter out funds based on your parameter. Now, if you go to the queries tab, this is something which is a much more robust version of the screener, meaning there are multiple columns that you could see in the screener if you scroll towards the right. Each of these columns could be used as a filter parameter in the query tab. Now, what you need to do is you simply come to this select static filter and click on this drop down. Right here, you can see all these filter parameters and create a list as per these filters that you want. Now, let's say I rather want to create a list of mid-cap funds. So I'll select this option as SEBI category. And right here, I'll select mid-cap. And I'll click on add condition. Anytime you add in any specific filter, you need to click on add condition to make sure that the filter takes into effect. Now, based on this first condition that I have input, it is saying that there are 29 mid-cap funds that could come up. Now, let's say I rather want to shorten this list based on its AUM. So I'll click on this drop down in the same process, click on the drop down, select the AUM. So here you can input a range from and to. So let's say I just want to limit it to 3,000, meaning I want to see only those mid-cap funds whose AUM is 3,000 crore and above. So I've input or rather edited only the lower bucket, and the maximum range, I have rather tried to keep it the same, meaning the only limitation that I want is I want to see only those funds whose AUM is 3,000 crore and above, and I'll click on add condition. Now, based on this, it is saying that there are 20 funds. Now, let's say I add in another filter parameter, which is value at risk. So I'll select historical value at risk. And here I'll edit and input, let's say 27. And I'll click on add condition. As of now, it is saying that there are in total 8 funds. And let's say I also add in one last filter parameter, which is, let's say, 3 years return, annualized return. I want to see those funds whose 3 years annualized return ranges from 15 to 40%. And I'll click on add condition. Now, based on these 4 filter parameters that have input, it's saying that there are in total 8 funds that are coming up, and you could click on show 8 funds and the data comes up on the right hand side. So you could see those 4 parameters that you had input, the data for each of them comes in a columnar view, and you can anytime sort this either in the ascending or in the descending order. And also the query that you created just now, you have an option to save this query. You simply click on this option of save this query, input a query name, and you click on save. The next time you come onto the platform, you simply need to go to the query tab and click on load saved query. The queries that you would have saved would show up right here. Now, let's say this is the list of fund which I rather want to compare, meaning I want to compare them with each other along with the benchmark as well as the category average. Now, the comparison of funds happens in the compare tab right below the funds tab. Now, how do you take the funds from this query tab till the compare tab? You can see this compare icon. Just by one click, this list of 8 mid-cap funds moves to the compare section. So it has rather gotten moved right here. Currently, the data that you're seeing for each of these funds, like the Sharpe ratio, the standard deviation, or the CAGR, would be since the inception of each of these funds, meaning this Sharpe ratio of 0.81 is for Axis Midcap since its inception. Reason being that I have not yet input a common start date, and that could be done using this settings wheel. You can see next to the returns column, there's a settings wheel. You simply click on that and you input a start date of your choice. Or you want to analyze this for the last 3 years, for the last 5 years, you can anytime put it accordingly. I have taken 9th August 2019. I'm analyzing them for the last 5 years. As of now, the data that you could see is for the last 5 years because we have input a common start date. Now, let's say I also want to add in its respective benchmark as well as the category average too. And that happens right here. There's this option called as add other items. So here you can search for the index. Since these are mid-cap funds, I'll add in Nifty Mid-Cap 150 as a benchmark, and it will get added in as a row item right here. And also the category average, that is also available right here, add other items section. Historical category average, I'll search for mid-cap. And it will also get added in as a row item. Now, since these are benchmark and category average, they are highlighted in a different color, which is blue, so that a differentiation can be made from a fund. Now, let's say I rather sort this data on the basis of its Sharpe ratio. You click on the column heading, the data can get arranged either in the ascending or in the descending order. So Sharpe ratio typically tells us the risk adjusted return for each of the fund. We see the highest Sharpe ratio is with that of Quant Midcap, followed by Motilal Oswal. Quant has a Sharpe ratio of 1.31, while Motilal to an extent of 1.20. And if we have a look at the list of the mid-cap funds that we have currently loaded, we can see that there are these two funds, Mirai Asset and Axis Midcap, that have a lower Sharpe ratio when you compare it to the benchmark Nifty Midcap. Of course, for the 5 years, the time period that we are considering, that plays a crucial role right here. And if at all we look upon it, you can see that there are these 5 funds that have outperformed the benchmark as well as the category average in terms of its Sharpe ratio for the last 5 years. Now, let's say you rather want to look upon the risk of each of these funds. You can anytime come to the standard deviation, annual volatility. That is what it will show. Highest risk is with that of Quant Midcap. So we saw Quant also had a higher risk, but it also had a higher Sharpe ratio. Similarly, the CAGR for Quant as a fund was the best in this list of funds that we are analyzing for the last 5 years. Now, let's say you rather want to look upon the capture ratios or the beta, which typically tells us how riskier a fund is when you compare it to that of the benchmark. Those columns are available once you scroll towards the right. You just need to use this smaller scroller that is available, move towards the right, and locate these pink color-coded columns. Currently, these columns are empty. Reason being, these are not yet activated. Now, how do you activate these columns? There's this option called as relative returns. You simply do a tick on this checkbox. The data starts showing up. By default, the benchmark that gets selected for these relative returns is Nifty 50. You can anytime change this as per your required or specified benchmark. So I've added a Nifty Midcap 150 as the benchmark. Now, post which you can also see a start date as an option. Now, it is rather suggested that the time period or rather the start date that you take in the relative returns column should be exactly similar to what you take in this returns column. Typically, because we want to do a fair comparison, an apples to apples comparison. That is the reason we say that the time period under consideration should be similar in the returns column, along with that in the relative returns column too. So I've taken up 9th August 2019. Now, if I look upon, let's say, beta, which typically tells us how riskier the fund is when you compare it to that of the benchmark. Now, beta of a benchmark with itself will always be 1, and beta less than 1 says that the fund is less riskier than that of the benchmark. Now, in this list, of course, all the funds have a beta less than 1, but out of this list, Quant has the highest beta, meaning in this list, Quant having the highest beta in comparison to Axis Midcap. It has something which has the lowest beta in this entire list. Followed by that, you can look upon the capture ratios, which was the second topic today. So up capture and down capture, these are the two ratios. Up capture typically tells us how did the fund perform when the benchmark was in a bull run, and down capture says how did the fund perform when the benchmark was in a bear run. Now, how did we arrive at these figures that you're currently looking upon? For that, I'll look upon it on a fund. So I had this Mirai asset loaded onto my tab. So I've opened this tab and you see the benchmark has been selected as Nifty Midcap 150. I have taken it as for the time period of 5 years. Let's say I keep it what I had taken in the relative returns column and the returns column. I'll take it as 9th August 2019. And I'll scroll down right here, up capture and down capture ratio. Now talking about up capture ratio, as I mentioned, it tells us how did the fund perform when the benchmark was in a bull run. Now here you see 93.4 is something that has been mentioned. Now how did we come up with this 93.4? The explanation is also available. You can simply click on this I button. So for the up capture ratios, we consider only those months when the benchmark had generated a positive return, irrespective whether the fund has generated a positive or a negative return. Now, for example, if at all we look upon in the month of Jan 2020, we can see the benchmark generated 5.3 return, while the fund's return was to an extent of 2.51 only, meaning in this month, the benchmark was able to beat the fund in terms of its performance. Once we consider all these months wherein the benchmark generated a positive return, we take a CAGR of these data set, which comes up to be 72.8 for the fund and 77.9 for the benchmark. Now, just by looking at this data, you can see that when the benchmark was moving up by 77%, your fund moved up only by 72%. Meaning you can say up capture ratio is rather lower for this specific fund. Now, how did we arrive at this 93%? It is typically division of 72.8 divided by 77.93. That is how we arrive at this 93.4%. Now, we say higher the up capture ratio, better is the performance of the fund when the benchmark is in a bull run. And by higher, we mean more than 100. And similarly, converse is the down capture ratio, in which we consider only those months when the benchmark has generated a negative return, irrespective whether the fund has generated a positive or a negative return. Like for example, in the month of January 2020, benchmark generated a negative return of minus 0.97, while the fund generated a positive return of 1.19%. So here in the down capture ratio, consideration is given to the benchmark return, irrespective of the returns generated by the fund. And in similar manner, we take in a CAGR of these data set, and it comes up to be negative 38.9 for the fund and negative 42.4 for the benchmark. Now, clearly, just by looking at these data, we can say that when the benchmark was falling by negative 42%, your fund fell down only by 38%. Meaning, in this time period that is under consideration, my fund was rather resilient to the movement of the benchmark when the benchmark was in a bear run. And here as well, this data that you see, 91.8, how did we arrive at this? Similar division of this 38.97 with that of 42%. And we say lower the down capture ratio, better is the resilience of the fund. And by lower, we mean less than 100. And that is what you could see right here. The explanation is something that you could find when you load in a fund. The data is something that we show right here. Now, this list that you're currently looking upon, you also have an option to save this list. You can anytime input a name. Let's say I'll input midcap August, and you click on this save icon. Your list can get saved right here. And the next time you come onto the platform, you just need to click on this my list and locate that specific list that you had created. And the entire data that was saved in the list would show up. Next, I would move on to the risk versus return scatter plot. So this is a scatter plot wherein on the x-axis, you could see annualized risk, meaning standard deviation. And on the y-axis, you could see annualized return. And the entire scatter plot is divided into 4 quadrants: low risk, high return, low risk, low return, high risk, high return, and high risk, low return. Now, if any of the fund gets plotted on this right-hand side of this scatter plot, we would say those are the ones which have higher level of risk in comparison to the ones which gets plotted on the left-hand side. those would have lower level of risk. And in a similar manner, if a fund gets plotted on the upper end of a y-axis, those would be the ones which would have higher level of return in comparison to the ones which gets plotted on the lower end of y-axis. Those would have lower level of return. Now, of course, in this time period under consideration, we could see two funds that are lying upon on the extreme ends of this scatter plot, which is Axis Midcap, which is lying in this low risk, low return quadrant. Meaning, out of this entire list of funds that I'm currently looking upon, Axis Midcap took in the least amount of risk and at the same time generated the least amount of return. While completely opposite is this Quant Midcap, which took in highest amount of risk and generated the highest amount of return. Of course, in this time period under consideration and also based on the list of funds that is currently there. Now, let's say I rather want to change this view that I'm looking upon to the last 3 years. So I'll select 9th August 2021 and I'll hit go. Now here, if we look upon, there is this fund, Motilal Oswal. This is lying in the middle, meaning you can say this is taking up moderate level of risk, but at the same time generating the highest return. It is at the upper end of the y-axis. That is the reason I said it is generating the highest return, meaning with a moderate level of risk in the last 3 years, it is generating the highest return. Now, if I change this again to the last 1 year, let's say I take 23rd August, 2023, 9th August. It is having the similar view specifically for Motilal Oswal. With taking up moderate level of risk, it is generating the maximum amount of return. So here you can change the time period accordingly and look which fund is generating higher risk or taking up higher level of risk and generating returns accordingly or not. Now, this data that you see could be instantly generated in an Excel. Excel download for the same is available. So you can see the first column showing what all was there in that scatter plot, risk being the second column and returns being the third column. Next, I move on to the drawdowns tab. Now, this tab typically lets us know how quickly does a fund recover from any loss that has occurred. And right here, we show in top 5 losses for each of these funds. The worst drawdown, of course, being in the first section. Now, here as well, you have an option to change in the start date. Now, every tab that you go on, you will be able to see 29th July 2019 as the start date that gets picked up automatically. Be it risk versus return, you see 29 July 2019, be it drawdowns. Now, the reason for that is typically the age of the youngest fund. Now, you see Mirai asset is as old as 5.05. So, in order to do a minimum common time period comparison, by default, the platform picks up the age of the youngest fund as the start date for analysis. But this is anytime editable. You can change this accordingly. Now, let's say I do an analysis on Motilal Oswal based on its drawdowns in terms of its NAV. You can click on this history icon. You simply click on that and here in detail, the loss for Motilal Oswal Midcap comes up. So here you see the loss is to an extent of 37%. The highest loss that was experienced was to an extent of 37%, wherein the NAV of this fund started at 29 rupees and this started falling and it reached a price of 18 rupees. Now, when did this happen? It happened typically from 20th Feb 2020 to 23rd March 2020. Meaning during the COVID period, the NAV of Motilal Oswal started falling from 29 and reached a price of 18. Now, post this date of 23rd March 2020, it took a total of 200 days, meaning 200 working days for this fund to recover from this loss of 37%. Meaning, by that I mean it took 200 days to cross this start price of 29.03. And it also shows when does the recovery happen. So right here, the recovery happened on 28 December 2020. You can anytime look upon them on this line graph. The white region shows the recovery phase and the gray region shows the drawdown phase. Now, let's say I just try to locate this 28 December 2020. I'll try to highlight this. Yeah. So right here, 28 December 2020, we can see the NAV of this fund was at 29.05, which is higher than the start price, which was 29.03. So that is the reason this date has been picked up as the date of recovery. Now, if at all we look upon this fund, Motilal Oswal, there's just this one occasion, which was typically a COVID period, a one in a situation wherein it took a maximum of 200 days for this fund to recover. Now, if at all we ignore this time that is under consideration, at max for this fund to recover, it took 38 days. Meaning, you could say that you can hold on to this fund, and based on its historical performance, based on its historical drawdown and recovery, this says that at max it takes 38 days for this fund to recover from its drawdown. So you can hold on to this fund looking upon its performance in the past. Now here, once you look upon in the worst drawdown section, there are three columns that you could see: size, length, and recovery. Size typically letting you know the magnitude of loss that was there. Length lets you know the number of days the loss continued, meaning we saw 20th Feb 2020 to 23rd March 2020. The number of working days between the start date and the end date is considered as length. And here that comes up to be 32 working days. And recovery tells us the number of days taken by this fund to recover from the losses. Next, I move on to the rolling stub. So this rolling stub typically lets us know the consistency of the funds. Now here you could see rolling window is something that has been mentioned. And next to that, it is 260 is something that has been mentioned. Now, rolling window is equivalent to the holding period, and 260 is equivalent to 1 year on the platform, meaning 1 year working days. Now, typically what you could see is this first column, which is average column. So this says the average return generated by Motilal Oswal in a 260-day rolling window comes to an extent of 30.15%. Now, what does this mean is, if an investor would have invested into Motilal Oswal for any 1 year from the start date of 29th July 2019 till this end date of 8th August 2024, if an investor would have invested for any 260 days, meaning any 1 year, their average return from Motilal Oswal would come up to be 30.15%. Now, how did we arrive at this 30.15%? This is typically the average of all these data points that you see on these line graph. Now, let's say I keep my cursor on this very first point on this line graph. So it says Axis Midcap 31st July 2020. And next to that, it says 14.58%. Now, this says that if an investor would have invested into Axis Midcap exactly 260 days prior to 31st July 2020, which would apparently be our start date. Our start date is 29th July 2020. Meaning, if I would have invested into this fund exactly 260 days prior to 31st July 2020, my return generation from this fund could have been 14.58%. Now, any point that you keep your cursor on, right here, HDFC Midcap, it says 27th May 2021. If an investor would have invested into this specific fund exactly 260 days prior to 27th May 2021, their return generation from this fund could come up to be 63%. Now, the average of all these data sets that you see right here is something that has been mentioned in this average column. Next to that, you can see VOL. Now, VOL stands for volatility on our platform and not volume. So this lets us know how volatile are these rolling returns that you could see for each of the fund that you have loaded in. Next to that is the high and low. High typically tells us the highest return that is generated by each of the fund from this start date up until this end date. And similarly, low, letting us know the lowest return that was generated by each of the fund currently in our list from our start date up until our end date. Now, range typically tells us the swing between each of the fund, meaning, let's say I look upon Axis Mid Cap. So it is typically saying that Axis Mid Cap can go as high as 60%, but it can also go as low as -8% in a 260-day rolling window. So based on that, the range, how do we arrive at this range is we typically add this 60 with that of 8. And that is how we arrive at this 69%. Next to that is this positive percentage column, which typically tells us the number of times a specific fund has generated positive return, considering that there are only two quadrants, positive and negative. Now, if at all we look upon HDFC mid cap, we could see 100% of times this fund has generated a positive return. Now, why is that? You can see even the lowest return for this fund is a positive figure. And that is the reason it says that 100% of times HDFC midcap has generated a positive return. Now, anytime you could change this rolling windows as well. You just multiply the number of years with 260 and the rolling window could anytime be changed. Next to that, what we have is this 260-day rolling return distribution tab. So here in total, there are 5 buckets with equal intervals. Now, how did we arrive at these intervals? You can see the highest bucket and the lowest bucket first. So here the lowest range for this bucket is -8.65. Now, typically this is the lowest return that was generated by any of the fund that is currently there in our list, which is Axis Midcap. Out of this entire list, the lowest return was generated by Axis Midcap, and that is what has been mentioned as the first bracket. And our last bracket is 88.39%. Now, this is typically the highest return that was generated by any of the fund in our list, which happens to be PGIM Midcap. Now, that is what has been mentioned. Now, how did we arrive at these intervals? I'll just show you in a calculator. You simply add up the highest bucket with that of the lowest bucket. So I'll add 8.65 with 88.39 and I'll divide this by 5. The reason being because we have 5 buckets and hence I am dividing it by 5. So the interval between each bucket comes up to be 19.41%. Now let's say I try to subtract this bucket. The second bucket, I just try to subtract. It is typically 30.17 subtracted by 10.76. So this is what we come up. So this is how we arrive at the interval between each bucket that you see. Now these interval buckets that you're seeing are anytime editable. You can just input your return range. Now let's say I want to look that which of the fund has generated a negative return. So I did not touch or rather change this lowest range of negative return. I just change the upper end to 0. So I rather want to look upon the funds that have backtested to generate negative returns only in a 260-day rolling window. So out of this list, maximum probability is with Axis Midcap. 11.9% of times, it has backtested to generate negative returns in a 260-day rolling window, followed by Mahindra Midcap Fund. And as I mentioned, you can anytime change these rolling windows. You just multiply the number of years into 260. I have input 520, which is equivalent to 2-year rolling window. Input the data and click on run. And all the data that you're currently seeing would change accordingly as per the rolling window that you have set it. So that is it for the topic related webinar. If anyone has any query, you can either unmute yourself or type down your query in the chat box.
Okay, so there's a question in the chat box which says, can you please explain why we take 260 as single year window for rolling returns? Yes, so everywhere on the platform, we consider only working days, right? So if you consider working days only, that comes to 260, which is equivalent to 1 year. That's why for 1 year equivalent, we consider 260 on the platform, right? So therefore, typically, if you want to do it for a 2 year period, so you simply multiply 260 by 2, that's 520. Therefore, we consider 520 as a 2 year equivalent and so on. Okay, so there's another question in the chat box which says, can you please explain rolling return distribution again? So sure. Ansu, can you please change the rolling window to 260? Right. So first of all, in this case, you see these are 5 buckets that you can see at the bottom. 260-day rolling returns distribution. Negative 8% to 10% is the first bucket. 10 to 30 is the second bucket. 30 to 49 is the third bucket. 49 to 68 fourth, and 68 to 88 fifth bucket. So these are the 5 buckets. Now, what we explained during the webinar is how have we come up with the default return ranges in these buckets, right? So the lowest point, I mean the starting point of the interval is negative 8.65. How have we arrived at that? So that is simply taking in the worst negative return of all of the funds under consideration. The worst negative return in the universe that we are currently analyzing is negative 8.65. That's by Axis Midcap. There is no other fund that has gone beyond this level. That's why that becomes our starting level or the interval starting range, right? So that's 8.65. Similarly, the highest, right? Highest return generated by any of the fund in this case is a 88.39, and that is by PGIM India large cap opportunities. There is no other, sorry, mid cap opportunities. There is no other fund that has given better return than this particular fund, right? Therefore, that's where we've arrived at the highest interval, 88. So now we've got lowest and we've got highest. Now, how we arrive at the size of each of the class intervals? So for that, we did that calculation, 88 minus 88 plus 8. That came to some 97 odd rupees. So that's 8.65 plus 88.39. That's 97. And because there are 5 intervals, so we divide it by 5. That's 19.40. That means every interval that you see will by default have a size of 19%. That's why negative 8 to 10. Why? Because the size of that is 19%. 10 to 30. Why? The size of that is 19%. That is how it gets loaded by default. Now, coming on to the explanation. Explanation is, if you want to see the probabilities of the funds generating negative returns only, then the first interval is what you will edit, keeping the lowest interval intact, so negative 8.65, and you will make it to 0, right? So that's the probability of each of these funds generating in the negative quadrant. So when we make it to 0 and the data gets updated, we see that Axis Midcap Fund has the probability of almost a 12% to generate return in the negative quadrant. That is below 0. Right? So this is how you can go on customizing these rolling returns distributions as per your requirements. For example, you want to showcase it to your client. What are the probabilities of each of these mid-cap funds to generate returns between, let's say, a target return range of 15% to, let's say, a 45%. So you can edit that and you can customize this interval accordingly. So let's say our use case scenario was 15 to 45, right? You put that value here or the target return range here, and you can get to know the probabilities. So in this case, we see that in this target return range of 15 to 45%, we have a Invesco India Midcap, which has the highest probability of 55% to backtest in this target return range, right? Followed by that is a Quant Midcap, which is having a probability of 52%. That means 52% of the observations of quant midcap in the last 1 year will be between 15 and a 45%. So this is how rolling returns distribution interpretation is. There's another question in the chat box which says, can you explain value at risk again? Um, sure. So value at risk is a measure of downside risk in a particular fund or for that matter, any portfolio. In this case, we are analyzing this for a fund, right? Which is Mirai Asset Midcap Fund. And the time under consideration is 5 years. If we consider 5 years into consideration and with a 95% confidence interval, right? That means we are 95% confident that there's only a 5% chance that the downside risk of this fund will be negative 26% versus to that of the benchmark, which will be negative 29%. If you want to understand this in a little better manner in layman terms, it simply means if 100 rupees is simultaneously invested in both the fund as well as the benchmark, then your capital of 100 rupees will get eroded to an extent of 26 rupees in this particular fund with a 95% confidence interval, right? On the other hand, for the benchmark, your capital of 100 will get eroded to an extent of 29 rupees. That means your capital protected, that will be higher in case of the fund. So that's a measure of downside risk of a fund as well as the benchmark. All right. So there's another question which says, how is standard deviation calculated? So volatility everywhere on the platform, we calculate that by taking into consideration the standard deviation numbers of the daily returns of these funds. Again, the volatility number is always shown as an annualized number. Even if in this case, the time period under consideration is a 5 years time period, you will see 18.50 is the volatility, that's standard deviation. It is always annualized. It is not absolute volatility of the entire time period of 5 years. It is always annualized. So we consider standard deviation of the daily returns of these funds, and we take a square root of 260 to annualize that number. That is how we calculate volatility on the platform.
Hi, this is Arnab. Just to add to that, the reason you may be seeing a different standard deviation number at other sources could also be with the frequency of data. Standard deviation on our platform is always calculated using daily prices. So what you see on the chart right there, mutual funds are obviously daily liquidity. They can be bought any day. They are not traded monthly. They're traded daily. So we always calculate standard deviation of daily returns. We have seen quite a few other sources, even AMCs themselves, quite a lot of times they calculate standard deviation on monthly data points. So we don't do that, and that could explain the difference. Generally speaking, we will never use monthly data points to calculate standard deviation. It's always on daily data. And as you can imagine, if there are only 12 data points describing the year, depending on how the months are doing, you could probably get a lower standard deviation like you're seeing. But it may not be really giving you the right picture.
Okay, there's another question in the chat box. In the main list, you added large cap category, and then added the benchmark, and the values disappeared. Okay, so we're trying to fix this bug, but troubleshooting for that is very simple. So you typically would be getting this view, right? Just tick on, yeah. So this is the view that you might get. Quite often when you load in a benchmark or for that matter add a category, if you get this error, you just need to go at the top below main list. You will see a table icon. You can click on that and just turn all columns again on. All the data will again show up, right? We're trying to fix this bug. But in the meanwhile, this is how you can troubleshoot that. Just pick that column, all the columns should show up. Any further questions? Please let us know. All right. Ansu, if there are no further questions, we can close for today.
Yes. Thank you all for joining in. You can anytime visit our YouTube page. We have a dedicated playlist for all the webinars that has been conducted up until now. Today's webinar will also be uploaded by the next week. We have a list of 123 videos that has been updated and uploaded at the moment. Thank you all for joining in. Hope to see you again next week with a new topic. Thank you.